Our next guest says it's nonsense to think the Fed's going to raise rates in 2 weeks as the surge in oil prices acts just like a rate hike in slowing down the economy. Joining me now for that case is Jamie Cox, managing partner at Harris Financial Group. Jamie, it's maybe a little intuitive that if you keep raising oil and gas prices, that it's going to be a throttling back of the economy. Is this going to be enough, though, to keep the Fed on hold?
I think so, Dom. I mean, if you think about the situation we're in right now, the market is doing very well. You have the economy cooking along at about 2.5%. There just really is no justification for the Federal Reserve to raise interest rates into a supply shock. It would make absolutely no sense. If they did, it would probably, institute or incentivize a recession. So I don't think the Fed's going to go that far. I mean, that's why you've seen them take this wait and see approach. That's why you've seen even the Treasury Secretary sort of validate the Fed's approach and not pushing them, with his bully pulpit to lower rates while this war situation is going on and causing energy prices to be high. So I don't think there's any chance that a dual mandate Federal Reserve will raise interest rates. And in fact, even the single mandate ones like the ECB are also on hold and not thinking about doing it either. There have been lots of concerns that the Fed might do so, but it's not likely. What I do believe will happen is that a lot of the market prognosticators who have priced out Fed rate cuts later in the year are going to be proven wrong. I think that the oil supply shock will slow the economy to a decent degree. And also there will be some disinflationary effects that come along with it, which may make some room for the Fed to lower the Fed funds rate a little more than what people anticipate. So I think it's going to be the reverse of what the market had thought a month ago.
Now, Jamie, let's put all of that in context around your opinion, your view of where the U.S. economy stands. Is it enough right now for us to say that the U.S. economy can sustain these types of shocks without any kind of help from the Fed?
I think, Dom, it is sustaining it currently. I mean, you see consumption patterns not really being affected that much. You see the major banks coming out with their earnings reports and sort of citing consumer strength. You have consumers who are, receiving maybe larger than normal refunds and they're spending it. As a financial advisor, I see a lot of spending patterns among consumers. I don't see a lot of changes in the way our clients are spending money. Projects are still happening. Vacations are still being taken. I don't see any discretionary changes at this point. I think most people sort of realize that the price of gasoline is a temporary phenomenon. So we're looking at it as the Fed probably is in a transitory type environment. So as long as that consumption pattern remains, the economy will still grow at a respectable rate this year. So I don't think that's really in the cards unless there is a long duration supply shock with oil. And that doesn't even look like it's going to happen. It looks like we're closer to the end than the beginning.